Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hi, everyone. Brian Love, head of Banking and Fintech at Travillian. So obviously, as we look at the fallout from Silicon Valley Bank and Signature Bank's failures, I started thinking about talent, and specifically started thinking about talent in the CFO and financial executive ranks of the banks that we deal with, community banks around the country. And I decided to invite one of the better strategic CFOs that I know onto a dialogue here about the CFO function. So I'd like to welcome Andy Borrmann, previous CFO at Southcrest Bank and Colony Bank. Good to see you, Andy. How are you?
Doing well, Brian. Thanks for having me.
You bet. So I wanted to kind of, get the clickbait question out there first, which is, could a different CFO or a different financial management team have saved these banks?
So I'm going to stick with SVB a little bit because the Signature failure, I think, is more complicated from the facts we know at this point, at least. And what I would say is, at SVB, I don't know that you could have saved the bank starting last week, but I think the balance sheet structure, and I think this is probably getting pretty obvious at this point, but the balance sheet structure could have been built differently over the last couple of years, where the earnings of the bank would have been substantially lower, but the risk profile would have also been substantially lower, and an event like happened last week would have been relatively avoidable. Hard to have 20% of your deposits run on a single day, no matter what your structure is. So I don't want to say yes automatically, but I think there's a balance sheet structure that would have worked better given the risk profile of having a highly concentrated client base that SVB had.
So you're thinking that, if you can go back in time and maybe implement a different strategy, that these banks obviously would have a different trajectory. So
yeah,
go ahead.
I was going to say, I think with the concentration they had in large depositors, which is something that every CFO should be looking at, is how much of your top 10 depositors are the total percentage, or your top 20, or whatever the number is for your bank, depending on the sophistication and liquidity needs of those customers. You need to understand what your daily liquidity needs should be and structure your balance sheet around sort of those minimums, if nothing else.
Yeah, so it occurs to me that, I can't opine on the talent levels at Silicon Valley Bank. I didn't know those folks, so I'm not going to pass judgment. However, you come out of 08 and 09, the CFO function does change due to regulations, due to DFAST, due to different types of volatility, right? How has the last 10 to 15 years changed the CFO function? And then as a follow-up question, I want to talk about how maybe even this situation will further change it.
Yeah, I think, the way I would say it about different CFO function, usually we're talking about accounting versus finance in that realm. I think the risk profile of banks has gotten overall more volatile because the marketplaces themselves have become more volatile because the speed of money has increased. And so in that situation, your day-to-day is, is not really any different, but the situations like this, like 08, 09, are more significant. COVID, completely, exogenous event, but it created real stressors on the banking system, and understanding your balance sheet from a structural what happens if standpoint, really risk management, not just what happened yesterday, but if rates go to 0 or rates go to 10, where are my weak spots? Where do I sit on that continuum? And how do I develop a balance sheet that is more sustainable over a larger risk profile? So it has to be a worse scenario for my balance sheet to get in trouble. And I think that's more of a financial management, balance sheet management tact than it is an accounting tact. And look, we need great CPAs who tell us exactly what happened and do the recons every day and all that sort of stuff. But when it comes to severe events, it's well-structured balance sheets thought out from a risk standpoint that really win the day.
That's the storytelling element of it.
Yeah, I think so. And so what I've tried to do in my career, over the last 10 years of being a CFO is to make sure I understand. I got my start in engineering. In engineering, you take variables from 0 to infinity. It doesn't make sense in banking, but maybe you take interest rate from 0 to 10, and see what happens in those scenarios over the next year or 2 years. And you really try to break effectively your balance sheet using scenario analysis effectively, and then understand why it broke. That's a weak point. What can we do to resolve that or fix it or put a Band-Aid on it? If it's really unlikely, we can talk about it and understand the risk. And if we get closer to that risk, then we can adjust as we go. But realistically, it's providing that understanding of your weaknesses internally to the rest of your executives and your teams, so they understand what you're managing to or away from. And also the same with your boards is so that they understand, look, if this happens, we're going to need to do some things that are non-traditional, and that's okay. Like, we know that already. We just hope that doesn't happen. If it does, we'll get to work.
No, that's a good point that you make. And it seems like that's almost the birthing of the true strategic CFO. When I think through this, more recently, there's been so much M&A over the last decade plus, right? It feels like the CFO function should be right on the front lines, understanding how new business or a new bank might bolt into the current balance sheet of the bank. And I'm not trying to generalize, but I do feel like there's probably some CFOs where they're maybe a little outmatched in that realm. Do you agree with that statement, or do you disagree?
I do. I think the strategy portion of the CFO role has started to work its way down in asset size over really since the financial crisis. I think COVID probably taught a lot of good lessons to this generation. If you think, the financial crisis really started 15 years ago. A lot of the guys that were CFOs at that point have retired. So you're talking about a new generation on top of it who have now had a shock that really didn't negatively impact the banking system. And we had to think hard through what was going to happen and what our risks were. But COVID really all it did is make us all bigger and more liquid. And so that by itself, hopefully brought some folks' eyes open. But I really think even at the $700 million size bank, I think a strategic CFO is still very additive to the overall long-term risk appropriate profitability, rather than I think they have a better job of creating a long-term sustainable outperformance than our accounting friends, who again are absolutely necessary, but trained to look in the weeds, not above the weeds.
That's a great point too that you make, because the sub $5 billion bank, a lot of banks that are smaller, sub billion even, the investment portfolios at those banks, those balance sheets are just less complex for the most part.
Mm-hmm.
But it still seems like in this day and age that the talent needs to be thinking about the future and about growth.
Right. Even though those balance sheets are less complicated, you have less moving parts just in general, doesn't mean you don't have an optimal structure given your liability set. And really this whole thing is based on what do your liabilities look like. That was what happened to SVB for sure. And so if you understand your liability set, which is the most important part of the strategic foundation for your future decisions, then how do you match your assets or your asset possibilities to the liability set that you have, and drive it from there. And so, a $50 million bank has a specific liability set. They may not be able to afford a strategic CFO who can't close the books every day. But realistically, the problem that, we'll talk about as a math problem's the same, right? We're just talking about zeros at the end of the numbers. It's understanding your liabilities and then appropriately structuring your balance sheet to match that liability set.
In an ideal world, should a billion, $5 billion bank have a CFO and a CAO or a good controller? I mean,
I
can they
think
be
so.
one and the same, or, you know, you think bifurcating that accounting function and adding that strategic CFO on top makes a lot of sense?
I think bifurcating it makes a lot of sense. And the reason is, you know, now I'm going to step into the accounting world a little bit. It's sort of that dual control, internal control aspect. It's as a strategic CFO, I know that my accounting skills are weak relative to a strong CPA who's a chief accounting officer. And I need to make sure that whatever idea, crazy harebrained thing I come up with is possible, can be accounted for easily, doesn't create adverse impact in other areas that I'm not thinking about. And I have always tried to have people as partners that were like puzzle pieces. They fit my weaknesses and I fit their weaknesses, and we're both stronger together. And you know, you get to $1 billion. I mean, Southcrest is 700 million. We had it at Southcrest where we had a chief accounting officer and a CFO. I think it worked really well. It's a little harder to do at that size, just given the expense, but you know, I think it pays for itself pretty easily, honestly, at that size. And you get bigger than that. I think it's, yeah, I don't want to call it automatic, but it's pretty close.
Well, it also occurs to me that if you have a really good strategic CFO and a really good chief accounting officer, and you've got a succession issue with your CEO, everyone might be able to just move straight up. A good strategic CFO could potentially run an organization as a succession answer. And then your chief accounting officer maybe can parlay into that CFO seat as well. Just kind of spitballing here, but it does make a lot of sense.
Yeah, I mean, every executive position at a bank, we all have strengths and weaknesses. You have strengths and weaknesses. I have strengths and weaknesses. You know, if at Southcrest my CEO got hit by a bus and I got moved up to the CEO role, I would have had strengths and weaknesses. My weaknesses relative to, you know, his would have been, I don't understand credit quite as well, and I haven't ever made a loan because I've been a finance professional my entire banking career. And so, you know, I would need a really strong chief lending officer or chief banking officer and a really strong CCO. But that's just, I mean, those guys are out there, and you can put those puzzle pieces together. It's understanding your strengths and weaknesses and just balancing those out. I mean, it's not rocket science.
Yeah. Well, last question for you, Andy. You know, as we're talking about executive teams, my last question is, how should a CFO, maybe in light of these crises, how should a CFO interact best with the executive team? You mentioned, you know, pricing in a previous conversation. You mentioned, you know, good ALM practices. But, you know, there's a lot of silos that exist even at smaller banks. And I'm just trying to figure out the best way that CFO can exert themselves, and maybe an accounting centric CFO can better become a strategic CFO.
Yeah, so I think that really comes down to education and educating the other executives about what you're good at, because you have your role because you're either a great accountant or you're a good strategic guy or some blend of whatever. I've always viewed my job as teaching the rest of the team where our future risks are based on the variables that I deal with as a CFO on a day-to-day basis. That's duration, it's pricing, it's interest rate risk, it's liquidity, primarily those four. You know, we have assets available to us that are on a continuum all the way from a treasury that's due tomorrow to subprime unsecured consumer lending or whatever. And how do the products that we're good at fit inside of that versus our liability set? And why, when we're controlling future financial risk, not current risk, but the future risk, are we saying we need to price like this, or we need to look at this product set and make sure that we don't have too much of it, or we want more of it? And educating everybody else about what the finance team is trying to do to mitigate future financial risk and how that could possibly impact the future profitability and, you know, ongoing sustainability of the company.
Andy, thanks again for your time today. Always nice picking your brain. Appreciate you jumping on with me.
Happy to do it. Thanks for the time, and love just talking about this stuff. Thank you very much.
That's my last name, so it's all good. Thanks, Andy.
Yep. Talk to you soon, man. I'll keep you up to date on what all crap is happening.
Oh, you bet.
And really do thanks for having me, letting me do this with you.